Dimensions Corporate Finance, with us on the show to talk about his thoughts on the markets and specific things. Ajay, good having you. Thanks so much for joining in. How is, if I can actually start off with the election question, how is it shaping up? I mean, I thought 66% was slightly below par, but difficult to take a call on one way or the other based on voter turnouts, I would guess. But what's the mood check? What's the feel? And thereby, what's the likely possible impact on the markets or the volatility?
Well, if you listen to your television channels, I think they present a very different story compared to on the ground, where at least people we meet are battling with more things about their own businesses, the volume issues, the slowdown in the economy. And of course the big compliance issues which are coming around with the ROC new guideline, GST annual return. So I think unfortunately I meet people and I'm encountering people who are more related to business side of the thing, and which are obviously under stress, because when the economy slows down, with so much of compliance things comes into place, you're obviously under stress. So I don't know which way they'll vote finally, but I think there is a serious issue of a revival of the economy on everybody's mind. And I think when we see the high frequency numbers of April, whether it's sales of cars or automobiles or tires or whatever, I think you'll find that things are not looking too good in the economy. And that's what is, I think, on the top of the mind of people we meet. Now, whether that goes into the rural heartland, I don't know, I haven't traveled there, but I hope that remains the top of the agenda for any government who comes. And the only thing is that I think important from our perspective when we lay out a strategy for investors for the current year is that if the present regime continues in the same power kind of a majority, then you need to continue your same investment strategy, which is what? Which is very simple: focus on the large caps, focus on the performers, and just stick to it, because the economic policy, and if it's 6% GDP kind of growth, then you're definitely looking at the bigger players making a bigger buck out of the economy. However, if this paradigm changes to a newer political system, perhaps you may see greater hope for the small and mid cap. So I think your investment paradigm changes quite dramatically if you look at this party A winning versus a party B winning.
Okay. What about the other factors? Crude staying where it is, dollar index at 11-month highs. You reckon that these are signs all pointing towards a near-term correction?
Well, I keep saying that market correction is very different than what's happening in the economy, because market correction has to do with things like, we have alternate days of sanity and liquidity. The day we have liquidity, if the market goes up, the day we have sanity, market goes down, depending on who wins the day. So it's not all about economy, it's all about global flows. At this point of time, this rally was driven by global flows, nothing to do with the local economy. Now, if that changes quite dramatically, if the view changes, if it slows down, quite obviously we are headed for a correction. One thing is fairly obvious, that the domestic investor is holding his hand on investments, very judiciously putting in money in, may not panicking out, but I think at every stage now we are seeing that they will try to take money out of the equity market for some time if the oil remains where it is and the economy remains at 6.5% GDP. So I think it's all a question of liquidity. Sanity says hold your hand, keep reallocating money if you can, but if liquidity comes, you make hay out of it and see your prices go up.
Good morning, Ajay. Just, while you're talking about, investing at these current levels, I mean, obviously the long-term prospects still seem to be sanguine for the Indian equity markets. But whether or not, the appropriate time is here, volatility is anyways at its peak. We've been seeing the India VIX now at these heady levels for quite some time now. It's been over a week that we've not even seen in this budge from these levels. Is that a cause for concern? And that would probably suggest a slight bit of a wait out, maybe?
Well, see, again, I keep saying that there's no universal law, because it depends upon where you start off in your life. There are lots of people we still meet, very high net worth people, who still don't have any money in equity markets. So it's just a question of where you're invested. I think the perspective has to be, if you're reasonably invested at 70-75% of your surplus money, I think you would hold your hand. But if you've got nothing in the equity market, you've got to start somewhere. So I'm not sure whether there's a one common answer to the whole question that you've asked, but the answer is very clear. That if you are not in the market, there's always you know the best time to go, but you go in the market, but you go from the top to the bottom. The key issue is, do you pick up the basement bargain stock, so-called basement bargain stock at this point of time. I think that's the biggest issue which is bothering people is, one, do we finish it out, do we book our losses, or do we average out, or do we buy fresh investment into these stocks? I think that's where the critical thing. Most of us have already got money in an HDFC Bank, a Titan, or a Bata, or a whatever it is. So I think the critical question lies in the bottom C category and B category stocks. I guess the answer there is, the C is a no. B, definitely there are signs of changes in some of the large companies, about 1,000 crore companies. You would trend to invest them because they're pretty cheap. And the third, of course, is commodity companies. If you look at a commodity company, they're really dirt cheap and dividend yields are phenomenal. We discussed, I think, in a past program as well, that some of the stocks give a dividend yield of 8 to 10%, and you just keep holding them for years and years. There are debt-free companies, whether it's in aluminium, whether it is iron ore. So I think there are different pockets in this market which give you value from different perspectives. One big pocket is commodities, which is a very high dividend paying, which is debt-free companies. Second big pocket is your 1,000 crore kind of companies who are running at a price to book of about 2, 2.5, which can offer great value over time. And of course, and also we must keep it in mind, the perspective, at the end of the day, global flows are very strong. If you look at, forget what you see FIs, if you look at the private equity space, look at the kind of money pouring into this country. So I think purely on liquidity standpoint, you can be sanguine to say that there is a lot of global liquidity still floating around, which is coming into the private equity market, can spill over to this market as well at any point of time. So liquidity wise, I think you're comfortable. Yes, the word you use, sanguine, is correct. But the question is, can you take away the little bit of pain which will come right now in this year as our economy starts to slow down further and further, unless something dramatically reversal happens? And I think you mentioned oil. Obviously, oil is a big killer for this market for all times. So the question is, can you withstand the pressure for 6 months? If you can, I guess you hold on and keep building your positions.
In fact, just since you're talking about foreign investors, I've had conversations with two big global fund houses which have a significant exposure to Indian equities, and they were of the opinion that these short-term turbulences are of no consequence in terms of taking a call on investment in India. And though they would really love for the valuations to be slightly more attractive, instead of paying 18 times, they would have liked to probably pay 13 or 14 times. That is still not a deterrent for them to invest in a country like India, considering the kind of heavy growth prospects that it has versus any other emerging market.
The challenge is not, I think the view is obviously correct, because they have to anyway allocate, institutions have to allocate money on country basis, region basis. So it's not necessarily that they have a choice not to invest in India. I think the key issue for the investor has always been and will continue to be, how do you churn this investment? Let's take the example. Your iShares did beautifully till last year. Fantastic return. Look at what has happened. It's collapsed from 39 or 38 to 21,000. Now, if you have not sold out, you've seen a fantastic return getting wiped out, maybe becoming a loss. So I think the challenge is not about equity market. The challenge for the investor is to find the sweet spot, if he can, to sell off some stocks and book the profit where the market is changing. If you look at Maruti's story, look at iShares, look at Page, market is strewn around with cases where you had a fantastic run and they have regressed. So the challenge is that how do you keep churning the portfolio more than remain? Obviously, all of us have been in the market. We keep investing. We're always long in this market by and large. The question is, where do you keep your money the next year around? What do you do for the next year? Is it the same set of companies, different set of companies, and so on? So while institutions say what they say, that they will keep the money long term, the question is, in which stocks do you keep this money long term? When do you call quits to certain sectors? I think that's the challenge which investors have to bear in mind, because keeping long term has meant money only for a couple of stocks, which is the MNC stock and things like HDFC Bank. Everything else has given deep corrections to investors. So long-term theory is right, but the key is, how do you keep churning your stocks?